I'm Matt Bishard with REIT.com here in San Francisco for REITWorld 2013, NAREIT's annual convention for all things REIT. I'm joined today by Glenn Mueller, professor with the University of Denver. Glenn, thanks so much for joining us.
Thank you.
You've recently done some research on the effect of ETF trading on REIT share price volatility. Can you give us some insight into what your work has revealed?
Well, exchange-traded funds are not really a unique vehicle anymore. They're really a mutual fund that just trades daily, actually during the day, as opposed to at the end of every day like a normal mutual fund would. But a derivative product showed up a few years ago, and basically they are leveraged ETFs. And in a leveraged ETF, the idea is that you get double the return of the stocks that you're investing in, but only for the day, or triple the return that you're getting. Or you can have an inverse leveraged ETF where it says if the market's down, you get a positive return, so they're shorting the stocks. And the problem is, what we found out in the research was that as these things grew, and especially as the market got more volatile back in 2007 and 2008, that if the market had moved during the day, let's say it was up 2%, by the end of the day it would be up 4%. Or if the market was down 2%, at the end of the day it would be down 4%, because each of these ETFs, they're trying to keep the same portfolio mix as an index, right? And if a couple of stocks move and others don't, they have to rebalance every day at the end of the day. And so their demand for either selling or buying stocks created a double volatility that shouldn't have been there. They're a derivative product, they're unregulated, and they've caused havoc in smaller areas of the stock market where the market capitalization isn't as huge.
So what should REIT investors do with this information going forward?
I've always said that in the short run, the stock market's emotional. In the long run, it's logical. And so if you go back and look at the return on REITs since we started the REIT index back in 1972, the return has been very good. If you bought it and put it away, just like if you bought a building and said, I'm going to own this building for the next 10 years, if you bought it and put it away 10 years, when you opened up and took a look, you'd be very happy. You would have had some more volatile up and down years with publicly traded REITs, but in the long run, you know, they're solid companies investing in real estate. It's the best way for individuals to invest in real estate, you know, and have good professional management and a big diversified portfolio of properties. So, you know, I feel strongly that they're good, and hopefully we can do something to regulate these leveraged ETFs to help reduce that volatility.
And can you give us one major theme that you're keeping your eye on for 2014?
Well, I think the biggest one is everybody's so worried about interest rates. And, you know, everyone believes that, you know, as interest rates rise, real estate prices are going to drop. And I just finished doing a study on it and found that historically the correlation between interest rate movements and real estate property prices, or cap rates, you know, the yield on it that we always use to strike pricing, is about 0.38%. So it's not a one-to-one relationship, if you will. As interest rates go up, real estate prices fall. Not there. But the market doesn't understand that, and therefore the emotion of the stock market is interest rates are going up. REITs look like financial stocks, which they're really not, right? It's very unfortunate that they've been lumped into that category. And what really happens is, think about the fundamentals. If you start with the fact that to have interest rates go up, we have to have an improving economy. Therefore, we have to have improving employment, and obviously along with that comes some inflation. But improving employment, every time someone's employed, they have to work someplace. So demand for real estate goes up. As occupancies rise, rents rise. And historically, what we've always found is real estate's a good hedge against inflation, and interest rates and inflation are almost perfectly correlated, right? So as interest rates go up and inflation goes up, real estate's always done better because of the increase in income coming from increasing occupancies and rents.
Great. Well, Glenn, thank you so much for your insights.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.